Bitcoin just hit a massive milestone that almost nobody saw coming, and what happens next could fundamentally change everything for crypto investors. Welcome back to Crypto Insights, your trusted source where we break down the most important Bitcoin news, predictions, and in-depth analysis you need to know. Before we dive into today's explosive Bitcoin updates, make sure to hit that subscribe button and ring the notification bell. New subscribers this week get access to our exclusive Bitcoin trading guide, absolutely free. Now let's get right into the 5 crucial Bitcoin developments that are shaping the entire market right now. First, let's talk about Bitcoin's current price action and what the charts are telling us. Bitcoin is currently trading at levels that haven't been seen since the last major bull run, with technical indicators showing strong momentum. Trading volume has increased by over 200% in the past week, indicating serious institutional interest. The weekly candlestick patterns are forming a classic bullish formation that historically precedes major price movements. What's particularly interesting is the consistency across all major exchanges, suggesting this isn't just isolated market manipulation. The Fibonacci retracement levels are aligning perfectly with our current price action, giving us clear targets for the next move. As we navigate the volatile waters of the cryptocurrency market, leading financial analysts are making some incredibly bold predictions about where Bitcoin's price is headed. The consensus among many top minds isn't just cautiously optimistic, it's aggressively bullish, painting a picture of significant growth within the next 6 to 18 months. These forecasts are capturing the attention of investors worldwide, from retail speculators to the largest financial institutions on the planet. Michael Saylor, a vocal Bitcoin advocate, confidently predicts the asset could reach $150,000 by the end of 2024, citing its status as a superior store of value to gold. Meanwhile, traditional finance giants are also entering the fray. Standard Chartered has put forth a target of $200,000 by 2025, but even these figures seem conservative next to the forecast from RK Invest's Cathie Wood, who envisions a path to $1.5 million per coin by 2030, driven by its integration into the global financial system. These predictions aren't just wishful thinking, they're rooted in concrete data, most notably the seismic shift in institutional adoption. The approval and wild success of spot Bitcoin ETFs in the United States, led by behemoths like BlackRock and Fidelity, have fundamentally changed the game. These regulated products have unlocked a torrent of capital from institutional and retail investors who were previously sidelined, providing a stamp of legitimacy and creating a persistent, powerful source of demand. This institutional wave is complemented by growing grassroots adoption across the globe. Countries like El Salvador have already adopted Bitcoin as legal tender, aiming to bank the unbanked and reduce reliance on the US dollar. But perhaps more importantly, in nations like Argentina, Turkey, and Nigeria, citizens are increasingly turning to Bitcoin as a crucial hedge against hyperinflation and political instability, using it to preserve their wealth when their national currencies fail. This represents a powerful, real-world use case that grows stronger with every economic crisis. This confluence of factors creates a classic economic scenario, a supply shock. With a hard-coded cap of only 21 million Bitcoin ever to be created, the supply is perfectly inelastic. For months following the ETF launch, institutional demand was absorbing more than 10 times the amount of new Bitcoin being mined each day. This immense buying pressure, chasing a strictly limited asset, is the core engine that analysts believe could drive prices to unprecedented levels. The final explosive ingredient is the Bitcoin halving. This pre-programmed event, which occurs roughly every 4 years, cuts the reward for mining new blocks in half, effectively slashing the rate of new supply. Historically, halving events have been the catalysts for Bitcoin's most dramatic bull runs. With the most recent halving now behind us, we are in a unique cycle. For the first time ever, a supply-reducing halving is colliding with a massive, institutionally driven demand shock. This powerful combination is why many experts believe this cycle won't just be big, it could be the biggest yet. The regulatory landscape for Bitcoin is shifting at a breathtaking pace, with pivotal developments emerging from the world's leading financial centers, particularly the United States and the European Union. For years, the crypto space was characterized by uncertainty, often labeled the Wild West of finance, which kept significant institutional capital on the sidelines, wary of the legal and reputational risks. That paradigm has been fundamentally altered. In the United States, the Securities and Exchange Commission's landmark approval of spot Bitcoin ETFs marked a watershed moment. This decision didn't happen in a vacuum. It was the culmination of a decade-long battle, significantly influenced by key legal challenges like Grayscale's court victory, which compelled the regulator to reevaluate its stance. This has created unprecedented clarity, providing a familiar, regulated, and accessible investment vehicle for institutional investors who were previously unable or unwilling to enter the market. The impact cannot be overstated. Major financial institutions, from investment banks to pension funds, are now able to offer and integrate Bitcoin services into their client portfolios with full regulatory compliance. The ETF structure acts as a crucial bridge, wrapping the digital asset in a package that meets stringent fiduciary and compliance standards. This regulatory green light has effectively opened the floodgates for a torrent of institutional capital that was previously sitting on the sidelines, waiting for a clear, compliant entry point. The entry of behemoths like BlackRock, the world's largest asset manager, and Fidelity, a longtime advocate for digital assets, has sent a powerful signal across the financial industry. They are not just offering Bitcoin exposure to millions of retail investors, they are legitimizing it as a viable asset class for sophisticated portfolios. This move from the fringes to the core of modern finance is a direct result of this newfound regulatory acceptance. Meanwhile, across the Atlantic, the European Union is taking a different but equally significant approach with its Comprehensive Markets and Crypto Assets, or MiCA, regulation. Unlike the US's enforcement-driven model, MiCA provides a unified, proactive legal framework for the entire 27-member bloc, establishing clear rules for service providers and robust protection for consumers. This domino effect of regulatory approval is spreading globally, with jurisdictions like Hong Kong and Switzerland also creating frameworks to attract crypto business. This global wave of regulation is creating a more stable and predictable foundation for Bitcoin's future growth, transitioning it from a speculative novelty into a recognized and integral part of the global financial system. The narrative around Bitcoin has undergone a seismic shift. Once dismissed by Wall Street, it's now being actively adopted by major corporations. This institutional embrace is accelerating, with Fortune 500 companies strategically adding Bitcoin to their balance sheets. This isn't a short-term trade, but a long-term strategic allocation, signaling a profound change in how corporate treasuries manage risk in an era of monetary expansion. Pioneering this charge is MicroStrategy, which made Bitcoin its primary treasury reserve asset, accumulating billions of dollars worth. They champion Bitcoin as digital gold, a hedge against fiat currency debasement. Following suit, innovators like Tesla and Block made significant allocations. These are bold corporate statements, signaling immense confidence in Bitcoin's future and providing a blueprint for other CFOs to follow. But institutional adoption isn't just about holding Bitcoin, it's about integrating it into global commerce. Financial giants like PayPal and Visa are building bridges to the Bitcoin network. By enabling Bitcoin transactions for their hundreds of millions of users, they dramatically lower the barrier to entry. This integration transforms Bitcoin from a speculative asset into a viable medium of exchange, increasing its utility and creating powerful network effects. This top-down validation has a powerful ripple effect, fueling retail adoption. The number of active Bitcoin wallet addresses has exploded, growing by over 300% in 2 years, with total holders now exceeding 100 million people. This growth trajectory is often compared to the early internet, suggesting we are in the early stages of a much larger adoption curve. Each new user strengthens the network and increases its value. A critical factor enabling this institutional wave is the maturation of the mining industry, especially its response to environmental concerns. Miners are increasingly seeking out the cheapest power, which is often stranded renewables. The Bitcoin Mining Council reports that the sustainable energy mix has surpassed 50%. This greening of Bitcoin is dismantling the negative ESG narrative, making it a more palatable asset for institutional investors. Underpinning this growth is robust, institutional-grade infrastructure. Regulated custody solutions from giants like Fidelity provide secure storage. The launch of spot ETFs has provided a familiar on-ramp for investors. Meanwhile, innovations like the Lightning Network are scaling transaction capacity. This maturing ecosystem provides the security, liquidity, and regulatory clarity that institutions demand, paving the way for the next wave of adoption. Looking at the short-term outlook, all major technical indicators are pointing toward continued upward momentum for Bitcoin. Market sentiment has shifted from extreme fear to cautious optimism, creating ideal conditions for sustained price growth. Bitcoin's decreasing correlation with traditional markets suggests it's finally maturing as an independent asset class. Long-term projections suggest Bitcoin could reach $500,000 per coin by 2030 if current adoption trends continue. The stock-to-flow model indicates we're entering a phase where Bitcoin scarcity will drive exponential price appreciation. Some experts believe Bitcoin could eventually challenge traditional reserve currencies as global monetary systems evolve. Let's quickly recap the 5 crucial Bitcoin developments we've covered today that are shaping the market. First, Bitcoin's technical analysis shows strong bullish momentum with increasing institutional volume. Second, leading analysts predict significant price appreciation based on adoption trends and market fundamentals. If you found this Bitcoin analysis valuable, smash that subscribe button and hit the notification bell for daily crypto updates. Next week, we'll be diving deep into Ethereum's upcoming upgrades and how they could impact the entire crypto market. Thanks for watching, and remember, always do your own research before making any investment decisions.